This is the monthly report on my dividend growth portfolio. July had lots of news because I sold all of my AT&T, and that led to other changes to tell you about. Hi, I'm Dave Van Napp. Before I get into the meat of the video, please click the thumbs up button if you appreciate this content. Subscribe to the channel and ring the bell to get notifications when we post new videos. Your subscriptions help us add content to the channel, so we really appreciate those. Thank you. This is my dividend growth portfolio. The colored lines on the portfolio are areas that I'm going to speak about in this video because they involve changes that were made in the last month. Don't try to absorb all the information in the whole portfolio now. We're going to take it off the screen and then put it back up at the end of the video so that you can pause the video if you wish to and study the details of the entire portfolio. In this video, I'm going to concentrate on the activity during July. This is my favorite chart for the dividend growth portfolio. As the legend says, reliable, steadily increasing stream of dividends. That is a quote from the business plan for this portfolio, and that is my main function in selecting stocks for and making management moves in the portfolio. As you can tell by the bar graphs, the portfolio's main function has been accomplished since I started it in 2008. This is a real money, real time, not a back test. Been going for 13 years. It resides at E-Trade. Let me talk about why the dividend bars go up each year. There are three reasons. First, I select stocks for the portfolio because they've shown a history of raising their dividends each year. That's my minimal requirement for entry into the portfolio, is that the stock has a history, a solid dividend history, and appears to currently have the financial strength and the inclination to continue to raise its dividend every year. So far this year, I've gotten 22 raises out of the 30 stocks that are in the portfolio. The second reason that the dividends go up each year is because I reinvest the dividends. I don't drip them, which is the automatic process of feeding the money right back into the stock that sent it. Rather, I collect the money in cash in the portfolio, and then once a month, generally in the middle week of each month, I make a selection and reinvest the dividends. That generates compounding because the new shares that I buy then immediately start to add to the dividend stream. Over the life of the portfolio, more than $39,000 now has been reinvested into the portfolio by means of that dividend reinvestment program. For comparison, I started the portfolio in 2008 with about $47,000. So I'm starting to get closer and closer to having reinvested dividends that are coming close to equaling how much money I started with in the first place. And the third reason that dividends go up each year in the portfolio is portfolio management. And that's an umbrella category that includes selling stocks sometimes, moving money around within the portfolio, things like that. So I don't run this as a buy and forget portfolio. It does lean towards buy and hold. My default judgment always is to hold a stock if I have any questions at all about whether I want to do anything. But I don't ignore everything, and I do make occasional changes to the portfolio. And now let's look at last month, because last month had a big change to the portfolio. This slide shows the activity generated by my decision to sell AT&T. I've discussed that decision in previous videos, so I won't go over it here. When I sold AT&T, that generated about $6,550, shown in red on this slide. The markings that are highlighted in yellow indicate new activity generated by the money that I got from AT&T. I basically split the money between a new stock, AbbVie, the pharmaceutical giant, shown on the middle line in this slide, and Pinnacle West Corporation, which is an Arizona utility that I already had some shares in and used money from AT&T to add to the size of that position. Just to quickly run across AbbVie, and this will give us a chance to review what the columns in the table, the portfolio table, mean. First year in the portfolio, 2021, because it's a new purchase. The sector, I keep track of sectors so that I can have a well-rounded, what I call a well-rounded portfolio, not all jammed up in a single area or two of the economy. AbbVie yields 4.4%. The number of shares went from 0 to 37. I bought 37 shares, starting from a position of not having AbbVie at all, for $4,300. That makes AbbVie go from not being in the portfolio to being about 2.6% of the portfolio. And the annual income from those 37 shares checks in right now at $192 a year. The bottom line shows the shares that I added to Pinnacle West. I went from 42 to 68 shares, so I added 26 shares. That took the value of the stock up in the portfolio to where it's now 3.4% of the portfolio. And with a new number of shares, that'll be generating $225 a year in dividends. This slide shows what some of the important impacts on the portfolio of making the trades that I just described in selling AT&T, buying AbbVie as a new position, and adding to Pinnacle West as a growing position. The first column in the table above and the table below shows my annual income. My annual income went down because AT&T was a very high yielding stock because its price had sunk, as I've described in earlier videos. Taking down the annual income from $5,211 to $5,007 means that my yield on cost dropped from 11.1%, which was a new high at the time I reached it, to 10.7%. And I looked it up. It takes me back 3 or 4 months in the growth that we saw on the green bar chart, the growth of the annual income. This took me back a few months. Doesn't take me back lower than the beginning of the year. And by the end of this year or early next year, I expect that the dividend stream will grow back to where it was, and the deficit from selling AT&T will be, I will have made it disappear. The dividend safety, shown in the middle column on each of these charts, shows how I improved the safety of the portfolio. AT&T had been rated as having an unsafe dividend because we know that they're going to be forced to cut it next year. They've already announced the numbers that will force that to happen. And so 9% of the income with AT&T still in the portfolio was rated as unsafe. After replacing AT&T with the two other stocks, no amount of the portfolio is rated as unsafe dividend income. 89% is dark green safe, and 11% is borderline safe. That comes from a single position Enbridge within the portfolio. And in the last column of both of the tables, you can see that I improved the inherent dividend growth rate of the stocks in the portfolio. AT&T was only giving approximately 2% per year in dividend increases for several years prior to when I sold it. And indeed, they had frozen the dividend. So they were expected to provide no dividend growth at all going forward. The two stocks I bought both have good dividend growth rates. And so across the whole portfolio, you can see that the inherent natural income growth rate averaged out over the last 5 years jumped from 5.8% with AT&T to 6.7% a year without AT&T. So overall, while I lowered the amount of income coming in right now, I expect to get it back through stocks that have safer dividends and that have a higher dividend growth rate. In addition to, I still have 5 months in the year left of reinvesting dividends and possibly making other changes to the portfolio that will increase the dividend run rate as the year goes on. Finally, in July, I reinvested dividends as I do once a month. This is kind of a big deal for me. For the first time ever, I've added an ETF, which means exchange traded fund, to my dividend growth portfolio. For the previous 13 years, I held all individual stocks. I still hold mostly individual stocks, but now I've added the Schwab US Dividend ETF, ticker symbol SCHD, to the portfolio. I did a previous video on SCHD, so I won't repeat the details about it. It's a multi-sector ETF focused in its own strategy on dividends and dividend growth. At the time I bought it, it's yielding approximately 2.9%. The number of shares goes from 0 to 6. It's a new position. I spent $450 to get those shares. Percentage of the portfolio, of course, is extremely tiny right now, just 0.3% of the portfolio, which will generate generate an annual income of $13 a year. I intend over time to continue to build up the position in SCHD so that it takes its place among the stocks that are in the portfolio as a reasonably sized position. This is just a starter position. I just have one last slide I want to show you about the portfolio, and that'll wrap up this month's review. This is from E-Trade, which is where the portfolio resides, and what it shows is the monthly dividend income projected out over the coming year. They do that by annualizing the most recent dividend paid by each of the holdings in the portfolio as if none of the stocks were going to raise their dividends or cut them, and as if nothing else was going to change about the dividend situation for each stock. We know from history and from our expectations that all of the companies are going to raise their dividends as the coming 12 months go on, but this is how forward dividend expectations are projected. This is an industry standard to do it this way. And the main reason I wanted to show you this isn't only to show the total for the year, which is $5,016. Before I said it was $5,007, so between the time I made the AT&T trade and replacement and the time that I pulled this slide just a couple days ago, there was one or two dividend increases in the portfolio. That's why this number is up to $5,016 for the year. But I also wanted to show you the quarterly seasonality in any portfolio, whether it's your own portfolio or you find it in a fund, for example. The monthly amount of dividends is going to change. They'll either vary like this, or in the case of my portfolio, they show a repetitive pattern every quarter. So if you look, there are 2 months left in this quarter, August and September, and you can see the black bar for August at the left side of the slide, and then the September bar next to it is bigger, and then the October bar falls back. So October, November, December go back up. Then it falls back in January, February, March. That's the season. I call it seasonality. The seasons are well, there's 4 of them a year. And within each quarter of the year, I get the same pattern. That's not at all meaningful to me. I don't care that the amount of money coming in each month is different, but I did want to show you the repetitive nature of the dividend income for this portfolio. And if you have a dividend growth portfolio, you'll have exactly the same kind of pattern in all likelihood. And here I'll keep my promise by putting the whole portfolio back up. We'll scroll the stocks up the screen so you can get a good look at them. If you want to hit pause on your video, please do that and you can study these stocks in detail. And that's about it for this portfolio. Please click the buttons, as I mentioned before, and use the comment stream beneath the video to ask questions, and I will engage you on the comment stream with comments back and forth and answering your questions. Thanks a lot, everybody. Bye-bye.